Hi there, this is just a very quick short topic video looking at the difference between nominal interest rates and real interest rates. Now the real interest rate is important because it makes a big difference to decisions, for example, that we make as households about how much we should save, and crucially real interest rates on loans for businesses. Let's take the example of a saver. The real return on savings is simply the money rate of interest that you get minus the rate of inflation. So a quick numerical example, let's say a saver is getting 6% nominal interest rate, which sounds very good, but inflation is 3%, then in real terms they're getting a positive real interest rate, but it's only plus 3%. Now real interest rates can also become negative, and that happens when the money or the nominal rate of interest is actually less than the rate of inflation. Let's take an example of the real interest rate on a loan for a business. So here's an example. Let's say that inflation is 5% in a country and the nominal interest rate on a loan is just 4%. Obviously that might rise over time, but it's only 4% at the moment. So in this case, the real cost of borrowing money is negative. The real interest rate is the nominal rate, 4%, minus inflation, 5%. So in that case, the real interest rate on the loan is negative. If you've seen a previous topic video on deflation, you'll know that price deflation can lead to an increase in real interest rates. Keep in mind the formula, of course. Real interest rate is nominal interest rate minus inflation. But if inflation is negative, well, it's minus and minus. So price deflation can lead to an increase in the real interest rate, both in terms of real interest rate on savings and also, crucially for businesses, the real interest rate on loans or on debt. Snapshot of the world economy just at the moment, just something to be aware of, that over the last, 25 or so years in developed countries and in emerging countries more recently, the real interest rate has been falling. In developed countries, just in the last, let's say, the last two decades, real interest rates have fallen by around 4 or 5%. If you just take a look at the chart on the left-hand side, the purple line is the nominal interest rate on 10-year government debt. The grey line is inflation. Actually, it's expected inflation 1 year ahead. So it's sort of stabilising at around 2%. So the purple line minus the grey line gives you the blue line, the long-term real interest rate. And go back to 1990s, early 1990s, the real interest rate on government debt, for example, was about plus 3, plus 4%. And as you can see, there's been a significant fall over the long term. Indeed, as we head into 2015, 2016, for many countries, the real interest rate on long-term government debt has become negative. In other words, the yield on debt, the interest rate on debt, is now a little bit less than the rate of inflation. That raises all kinds of very, very interesting questions about whether government should be borrowing more, for example, to take advantage of these very low, historically low, real interest rates. So hopefully this has been useful in terms of just making clear the difference between the nominal interest rate and the real interest rate. Just a reminder, the nominal rate is the money rate of interest that you get or you pay. The real interest rate is the nominal rate minus inflation.